What if the most successful financial innovation of the last century wasn't the index fund, the credit card, or the blockchain, but the lie? A specific, elegant, and endlessly repeatable lie, one that has separated millions of people from their life savings, yet remains almost impossible to eradicate. In fact, it thrives. We give this lie a name: the Ponzi scheme. We think of it as a crime, a historical curiosity, the work of a lone, greedy charlatan. But what if that's exactly what the lie wants us to believe? What if the Ponzi scheme is not an aberration, but a feature? A dark mirror held up to our deepest financial desires. This is not a story about one man named Charles Ponzi. It is the story of the algorithm of greed. An algorithm so simple a child could understand it, yet so psychologically potent, it has fooled kings, governments, and Silicon Valley billionaires. It is a story with a clear, repeating three-act structure: the enticing promise, the unsustainable math, and the devastating collapse. And as we'll see, we are living through its greatest act right now. Today, we trace the curious history of the Ponzi scheme from its pre-industrial roots to its digital afterlife. We'll uncover its fundamental mechanics, the engine that makes it run. We'll see how every attempt to fix it has failed, not because the regulators are incompetent, but because the scheme adapts, finding new clothes for every new era. And by the end, you'll possess the only tool you'll ever need to detect it, no matter what form it takes. Our story doesn't begin in 1920s Boston. It begins in the powdered wig and debt-ridden courts of 1719 Paris. The protagonist is a charismatic Scottish financier named John Law. France is bankrupt, drowning in the debts of the extravagant Sun King, Louis XIV. The currency is debased, the economy in shambles. Enter John Law, a mathematician and gambler with a radical theory that money is not value, but credit. That confidence, not gold, is the true basis of wealth. He convinces the regent of France to let him establish a central bank that issues paper money, backed by the king's credit. It works initially. The economy stirs. Then, Law acquires the Mississippi Company, which holds a monopoly on trade with the vast, supposedly gold-rich territory of French Louisiana. Here's where the alchemy begins. Law merges his bank and his company. He starts selling shares in the Mississippi Company, financing it with the paper money his own bank prints. He orchestrates a propaganda campaign of unbelievable proportions. Tales of mountains of gold and emeralds in Louisiana, of a new El Dorado. He creates a system where you could buy shares on margin, paying only a fraction of the price, fueling frenzied speculation. The result, the Mississippi bubble. Shares skyrocket 10,000%. A beggar could become a duke overnight. The streets of Paris clog with carriages of new millionaires. The value wasn't in Louisiana exploration. Parties found only swamp and mosquitoes, but in the belief that the next person would pay more. This was the primordial Ponzi, value detached from any underlying asset, sustained purely by narrative and influx of new money. The cause was desperation and a seductive story. The effect was a mass financial hallucination. When the smartest investors tried to convert their paper profits into tangible land or gold, the truth was revealed. The bank didn't have enough specie to redeem the notes. Confidence shattered. The bubble popped with apocalyptic force, ruining the French economy and discrediting paper money for decades. John Law fled in disgrace. The blueprint was drawn: create a compelling narrative tied to a seemingly complex financial innovation. Use early success to create social proof. Depend entirely on a constant accelerating influx of new capital to pay off earlier investors. The moment the influx slows, the illusion dies. For nearly 200 years, this pattern would reappear in fits and starts. The South Sea bubble in England followed a near-identical script. But it awaited its namesake, the man who would perfect the lie into a streamlined personal brand of theft. Enter Charles Ponzi, 1919, an Italian immigrant in Boston, charming, ambitious, and perpetually in debt. He stumbles upon a footnote in the financial world: international reply coupons, or IRCs. These were coupons bought in one country that could be exchanged for postage stamps in another, a system to facilitate international mail. Ponzi noticed that due to volatile post-war exchange rates, an IRC bought in, say, Italy, could theoretically be exchanged for more expensive stamps in the United States. The difference was a few cents, but in his mind, he saw a fortune. He promised investors a 50% return in 45 days, 100% in 90 days. His stated business, the arbitrage of these tiny paper coupons. This was the genius twist. The Mississippi Bubble was a national mania. Ponzi scheme was retail, personal, and accessible. He didn't sell shares in a distant land. He sold a contract, a promise, directly to the shopkeepers, policemen, and housewives of Boston. His narrative was perfect for the era, a complex international financial arbitrage that only he, the clever immigrant, understood. The cause, post-war optimism and a universal hunger for easy wealth. The effect, money flooded in. At his peak, he was taking in over $1 million a week in 1920s dollars. But here's the truth, Ponzi knew from the start. The math was impossible. The volume of IRCs needed to justify the returns was greater than the total global supply of mail. He wasn't conducting arbitrage. He was simply using new investors' money to pay the promised returns to earlier investors. The profit was just recycled principle. The scheme became a self-fulfilling prophecy. The spectacular payouts to early believers created irrefutable social proof. Newspapers wrote glowing profiles, lines stretched around his building. People mortgaged their homes. The influx of new cash was so furious it sustained the illusion far longer than anyone thought possible. For nearly a year, Ponzi lived as a king, hailed as a financial wizard. He had industrialized John Law's bubble. He removed the pretense of a real company, distilling the scheme to its purest form. Cash in, cash out, with a compelling story as the only product. The breaking point was inevitable, not from a lack of believers, but from the relentless logic of exponential growth. The Boston Post began investigating. Financial columnist Clarence Barron pointed out the mathematical absurdity to cover the liabilities. Ponzi would need to process 160 million IRCs, while only about 27,000 existed. The narrative cracked. When authorities demanded an audit, the game was up. The flood of new investments slowed, then stopped. The payments ceased. The collapse was sudden and total. Thousands were ruined. Ponzi went to prison, his name forever etched into the lexicon of fraud. He gave the scheme its modern name, but more importantly, he proved its terrifying efficiency in a media age. The press could build you up, but it could also tear you down. The next great schemers would learn to manage the narrative more carefully. For decades after Ponzi, the scheme proliferated in the shadows. Affinity frauds in churches, small-time operators in strip malls. It was seen as a crime of the naive and the greedy. Then, in 2008, the world discovered that the largest Ponzi scheme in history wasn't in a boiler room, but in the very heart of the financial establishment. Bernie Madoff, former chairman of the Nasdaq, a pillar of Wall Street respectability. His scheme didn't promise 50% returns. That would have been gauche. He promised steady, consistent, modest returns around 10 to 12% per year, rain or shine. His product was exclusivity itself. To invest with Madoff was a privilege. He turned clients away. He created a velvet rope around his fraud. This was the scheme's brilliant evolution. It had moved from targeting the greed of the masses to exploiting the vanity and fear of the elite. Hedge funds, celebrities, charities, international banks, they all clamored to get in. The cause was the ultimate social proof. If the smartest people in the room are doing it, it must be legitimate. The effect was a massive decades-long transfer of wealth from the sophisticated to the conmen. Madoff's tools were different, but the core algorithm was identical. First, the compelling narrative. He cultivated an image of genius, using complex and fake split-strike conversion strategies to explain his consistent gains. He weaponized financial jargon as a smokescreen. Second, the social proof. The client list was his most powerful marketing tool. Third, the dependency on influx. He needed a constant stream of new, large investments from feeder funds to cover withdrawals and returns. For over 20 years, it worked. He survived SEC investigations because the investigators, in awe of his reputation, couldn't believe the truth was as simple as a ledger fraud. The scheme became a too-big-to-fail lie. Its collapse wasn't triggered by a skeptical journalist, but by the 2008 global financial crisis. Here is the critical cause and effect. In a crisis, investors need liquidity. They made withdrawal requests to Madoff totaling $7 billion. The necessary influx of new money dried up overnight. The exponential math, dormant for decades, suddenly awoke. The scheme, worth an estimated $65 billion on paper, imploded in days. Madoff confessed to his sons. The fallout was catastrophic, but familiar. Lives were ruined, charities shuttered. The shock wasn't the existence of a Ponzi scheme, but its location at the pinnacle of finance for a generation. The fix was more regulation, more scrutiny of investment advisors, but the algorithm simply observed, learned, and prepared to evolve again. It was ready for its greatest transformation, leaving the world of regulated finance altogether. Today, the Ponzi scheme hasn't died. It has undergone a digital mitosis, splitting into 1,000 fragments across the unregulated frontiers of finance. It has found the perfect ecosystem, one built on hype, technological obscurity, and a generational hunger for disrupting the old, corrupt system. Observe the modern parallels. First, the OneCoin saga, a blatant classic Ponzi, dressed as a cryptocurrency from 2014 to 2019. It promised revolutionary blockchain technology. It had no blockchain. Its coins were entries in a private database. It sold educational packages and recruited members in a multi-level marketing structure, extracting $4 billion globally by appealing to those left behind by the crypto gold rush. The narrative was crypto for the masses. The product was, again, nothing. Second, the DeFi or decentralized finance yield farming craze. This is where the scheme becomes algorithmic and decentralized. Platforms would offer astronomical, unsustainable yields, sometimes 1,000% APY, to attract deposits of cryptocurrency. The yield was often paid in the platform's own newly minted token. Early depositors got rich as the token price pumped from new buyers, creating a frenzy. When the influx of new money slowed, the token would collapse, leaving latecomers with worthless assets. The narrative was democratizing finance. The mechanism was a Ponzi dynamic coded into a smart contract. Third, the NFT bubble of 2021. While many NFTs had cultural value, the mania phase followed the pattern. Buy a digital image because you believe a greater fool will pay more for it, the narrative was owning the future of culture and community. The value was purely derived from the next buyer's belief. When sentiment shifted, the music stopped. The shocking modern data point is psychological. A 2023 study found that over 60% of investors in cryptocurrency were motivated by fear of missing out, or FOMO. This is not an investment thesis. It is the precise emotional fuel the Ponzi algorithm requires to function. The cause of this new golden age is the democratization of narrative creation. Anyone with a Twitter account and a slick website can craft a story of disruption. The tools of social proof are now global and instantaneous. Paid influencer endorsements, fake communities on Discord and Telegram, manufactured trading volume on unregulated exchanges. The effect is a landscape where the Ponzi dynamic is embedded in the very culture of speculation. The fixes of the past government regulators are often years behind, lacking jurisdiction or technical understanding. The scheme has finally found an environment where its core vulnerability, the need for trust in a central figure, can be diffused across anonymous code and decentralized communities. So, after 300 years, from the courts of France to the servers of Silicon Valley, what have we learned? The Ponzi scheme is a financial virus. It mutates, but its DNA remains constant. To protect yourself, you need to understand its three immutable laws. 1. The law of the miraculous source. All Ponzi schemes require a story that explains returns that are too good to be true. This source must be just plausible enough, yet just obscure enough to avoid easy verification. John Law had Louisiana. Ponzi had postal coupons. Madoff had his black box strategy. Crypto schemes have proprietary algos or revolutionary consensus mechanisms. If you cannot clearly understand and independently verify how the profit is actually generated, you are not investing. You are buying a narrative. 2. The law of social proof as a weapon. The scheme does not convince you logically. It convinces you socially. It shows you the line of people getting paid. It parades testimonials from doctors, celebrities, or savvy-looking youth. It creates an aura of exclusivity or a frenzy of inclusivity. It uses your trust in a community, an influencer, or the smart money against you. In the digital age, this proof is easily manufactured. Bots, fake reviews, paid shills all are cheap to rent. 3. The law of liquidity dependence. This is the mathematical heart. The scheme requires an ever-increasing flow of new money to survive. It is a perpetual motion machine of other people's capital. Therefore, it must always be selling, recruiting, and marketing. It cannot afford to be quiet or closed. Any operation that is more focused on recruiting new investors than on explaining its tangible revenue-generating business is broadcasting its true nature. This leads us to the unsolvable problem. The Ponzi scheme is not a failure of intelligence. It is a failure of human psychology. It feeds on universal desires, the desire for easy wealth, for community, for being part of the next big thing, and for trusting those who seem successful. You cannot regulate away human nature. Furthermore, in an economy that increasingly rewards financial engineering over production, where speculation often outpaces wages, and where complex systems are inherently opaque, the line between a legitimate bubble and a criminal fraud becomes dangerously blurred. Is a hype-driven startup burning venture capital to buy user growth with no path to profitability? Fundamentally different in structure, it too requires a constant influx of new capital based on a future promise. The ultimate warning is this: the biggest future Ponzi schemes won't be called Ponzi schemes. They will be called disruptive platforms, revolutionary tokens, or exclusive wealth management strategies. They will wear the uniform of the day. Your defense, therefore, cannot be a list of rules. It must be a mindset. Become allergic to obscurity. When you hear a pitch, perform a simple test. Ask, where does the cash profit come from before I invest my money? If the answer is vague, involves recruiting others, or depends on selling an asset to a future buyer at a higher price, walk away. Educate yourself on the basic math of investing. If something promises returns vastly higher than the historical average of the stock market, about 7 to 10% annually, with low risk, it is statistically a fraud. Diversify your skepticism as you diversify your portfolio. Most importantly, understand that the greatest tool a fraudster has is your own imagination, your ability to picture a richer, easier future. The Ponzi scheme sells that picture. Your job is to demand the blueprint, the foundation, and the independently audited bricks and mortar. If they can't provide it, they're not building you a house. They're selling you a dream that will vanish with the morning light. The curious history of the Ponzi scheme is ultimately our history, a chronicle of hope, greed, and self-delusion. It's a story that will have new chapters for as long as people dream of something for nothing. The question is not if a new, irresistible version will appear. It will. The question is, will you recognize the old, familiar algorithm whispering beneath the new, high-tech disguise?